Welcome everyone to our mid-August Global Credit Outlook webinar. The title says mid-year on the next page, but we're nearly halfway through the third quarter, which means we're already sort of peering into early 2027. I'm Logan Miller, and I lead the European strategy efforts for CreditSights. Today, I'm pleased to be joined by several of my esteemed colleagues. Regis Chatellier is our head of emerging market sovereign strategy based in London. Pramod Shenoi is the head of APAC research and Asia financials based in our Singapore office. And finally, Lox is the head of our South and Southeast Asia corporates as well as GCC corporates. So today, the purpose of the webinar is really to provide a high-level view of global credit markets, discussing our sort of top of mind themes and strategy recommendations for the remainder of 2026 and the early part of 2027, but also along the way highlight actionable trade ideas for investors that we hope you find useful as you're thinking about portfolio allocation and just your overall strategy towards directing capital to the credit market. So I will run through key themes for global markets, parroting off of our U.S. strategy team before diving into my kind of core views for European credit. We'll then transition to the outlook for EM sovereigns before moving on to GCC banks and GCC corporates. Before we start, there is a Q&A icon on the webinar interface. Please use that to write in your questions, and we will save time after our prepared remarks to hopefully respond to your questions. So again, welcome everybody, and let's jump right into it. So first, I'm going to go over obviously some of the U.S. views from our strategy team based in New York and Charlotte, and sort of tie that into sort of how we're thinking about global positioning across credit markets. And while my focus is obviously predominantly on European credit, I'm going to first kind of set the stage with some of the key views from our U.S. strategy team led by Winnie Caesar and Zach Griffiths. Hopefully provide some global context around U.S. market developments. So what a year it's really been so far for global credit markets, with a series of unexpected macro and geopolitical surprises, really a long list of concerns spanning from private credit to debt-financed AI Capex spending. And through it all, global credit spreads have been consistently resilient in the wake of even meaningfully higher borrowing costs for corporates and governments alike. Obviously, volatile commodity prices due to the ongoing conflict in the Middle East region. And obviously, and finally, just a heavy primary market activity that we've seen, which really has run full steam ahead throughout the year, particularly in the US and European investment grade markets. So investors have truly had a long list of items to balance this year. Many of the narratives that came into the year have either changed course in a rather material way, or even become sort of more pronounced as it relates to both the potential risks and opportunity set in global fixed income market. And so the slide up here has some of our base assumptions heading into the year for U.S. credit markets. And then we kind of go through how some of these developments have changed. Obviously, I think the big underlying driver in terms of what's driving interest rates across global markets has been the oil markets, or oil and gas markets. We were coming into the year a bit oversupplied, expecting to see kind of oil prices move lower. That obviously flipped in a material way at the end of February, and we've seen a consistently higher structure of oil and gas prices since the onset of the Iran war and ongoing closure of the Hormuz Strait. As we look forward, we are obviously keenly focused on potential de-escalation in the Middle East region. We would, under that sort of assumption that there is some sort of resolution in the coming months, we would expect to see kind of oil prices retrace as tension ease. Probably weighing a bit on energy valuations, particularly maybe on the equity side, but supporting sort of our core view that we should start to see some disinflation throughout the year and heading into 2027. Now, I'll get into some of the views on rates and duration, but clearly, the term structure of U.S. interest rates has moved considerably higher over the course of this year. We were expecting to see coming into this year, possible rate cuts by the Fed, and we were expecting to see kind of a bull steepener in Treasury yields, led by a decline in the front end. That narrative is clearly flipped, with inflation sort of trending higher and energy costs, definitely weighing on consumer prices, or pushing consumer prices a bit higher. I'll talk about sort of how this sort of what this implies for our view on the Fed, and sort of long end Treasury yields going forward. But that's been obviously a key driver of fixed income performance this year. And then the other kind of key theme I want to mention, and we'll have a slide on this as well, is just obviously the AI story, particularly around Capex expenditures, which have been debt financed by the large five kind of major AI hyperscalers. We'll talk about how that sort of has impacted market technicals and where we see that playing out through the end of this year and into next year. So first, I want to highlight some of our kind of core views for rates and duration. For those who follow our research already, you might recall that in our second half 2026 slash first half 2027 preliminary outlook for U.S. credit, we did change some of our macro calls on U.S. rates. Like I mentioned, one of the big shifts this year has been the direction of Treasury yields alongside higher energy prices. But despite that, we have a relatively non-consensus call around U.S. rates, particularly in our base case scenario. First, the market has clearly shifted for calling for tighter policy rates by the Fed. We actually think this is at odds with what the Fed might actually do for the remainder of 2026. In fact, our base case scenario for year end is basically no change in the Fed funds rate, and even into the first half of 2027. And that view is largely premised around inflation not warranting a rate hike. We think there's enough uncertainty around the labor market to keep the Fed on a hold, keeping in mind that the Fed does have a dual mandate to control prices, but also support sort of the maximum employment mandate of the Federal Reserve. As evidenced in the July CPI print, we saw headline prices rise 0.1% month over month, really kind of matching consensus and rebounding from June's 0.4% decline. But also we saw core prices, probably more important for the Fed, meet expectations at 0.2% month on month and 2.5% year over year. Now, obviously, 1 month does not make a trend, but we do think this supports the view that inflation is stabilizing rather than materially reaccelerating. And then on the labor side, we saw July wage data also point to some easing of labor market inflation pressure, with average hourly earnings rising just 0.1% month over month, which was below consensus, and leaves sort of a 3-month annualized pace at a modest 2.3%. So a bit of less pressure on the inflation side. And then you turn to non-farm payrolls in aggregate fell 23,000 in July versus consensus expectation for an 80,000 gain for the month. That marks the third consecutive week July print, and also pushes the 3-month average job gains down to 20,000, which is the softest pace since the end of February. So taking that all into consideration, we think the combination of weak payroll growth, declining participation rates, as well as continued wage deceleration is sufficient to keep the Fed on hold in September, while broader labor market questions should support a kind of a case for a hold through the end of this year. Now, again, this kind of runs against what the market appears to be still calling for a rate hike. We do think that if the Fed decides to keep rates on hold, this could certainly cause more market consternation. Normally, we would expect to see kind of a bull steepener in a scenario where the Fed is on hold, but as we've seen in the last 2 Fed meetings, the curve actually bear steepened after the FOMC decision. So what's kind of driving 10-year Treasury yields, and where do we think this is headed? Well, I think overall, the recent rise we've seen over the last, call it, month or so has been really driven by real rates. And we don't actually think that the elevated real yield environment is necessarily proving to be such a bad thing for risk assets. We think the move in real rates is partially explained by fiscal risk, but really the lion's share of the move higher has been about the reality that economic growth remains very robust by historical standards in the U.S. And importantly, despite recent moves in risks and rates, risk assets have performed quite well. We've seen equities continue to hover near or break new record highs, and credit spreads on global credit have continued to hover near the tight end of the cycle range. That's particularly true for U.S. and European credit in the investment grade space. So in terms of positioning, we did downgrade our duration call on the U.S. market from overweight in the first half of this year to neutral at the end of June. That's so far, I think, worked out favorably um, in our favor. Our view really is that there's probably still some upside risk to our 10-year call due to really economic resiliency rather than some concerns around fiscal and inflation. However, we continue to maintain a base case target that's just lower than current levels of 4.35% for the 10-year by year end 2026. That would imply basically kind of a 30 basis point or so rally through the end of the year. So actually a bit more of a rally than we anticipated heading into the second half. So let's jump into one of, if not the most impactful developments of the year, which has been around AI Capex spending. Many call it a concern, while others, including ourselves, actually think valuations, particularly in the tech sector, are looking relatively attractive, compared to underlying fundamentals and credit metrics. However, the technical overhang, technical headwinds, we expect to really persist for the next couple of years. So it may be a bumpy ride for the sector as we go forward. We think the net supply component is also really kind of fueling a higher term structure of rates for all corporate borrowers via sticky long end sovereign yields. We think that also helps partially explains the reason why we've seen such an increase in the 10-year yield and over the past month or so, just based purely off of the net supply of fixed income, particularly on the U.S. markets. This year the U.S. IG tech sector is running at a pace of 250 billion. That's by far a record. Hyperscalers, have issued around 212 billion year to date. That's been a kind of across a range of markets, obviously dominated by the U.S. market, but we've seen a number of huge mega deals, pricing whether it's euros, sterling, even CHF, Swiss franc, and Canadian dollar. It's been kind of a broad suite of issuance across currencies to be able to kind of diversify the investor base and also continue to meet very heavy supply needs in terms of capex spending. So our head of technology research, Jordan Shefflin, pencils in around $825 billion of hyperscaler capex in 2026. If that's realized, that would mark a whopping 84% year over year increase. And he also expects to see capex rise again across the board in 2027. So again, expecting to see technical headwinds for the sector persist, but ultimately we think that valuations are going to prevail, and so we continue to kind of favor putting some continued capital to work when things sell off in the tech space, particularly around AI spending. That being said, I think it's all going to come down to the technicals. We think it's going to come down to the technicals going forward. Despite sort of persistent technical headwinds due to high tech issuance, it hasn't had a broadening out effect on credit spreads more broadly, especially from a global perspective. There has obviously been some weakness in spreads in the major hyperscaler issuers, but so far it has not spilled over to other sector valuations. So how are we thinking about sort of the surge in debt finance, AI spending this year? I think there's certainly been some recent fatigue in some of the recent deals. We think that the healthy level of concessions, for the recent Alphabet deal, in spite of a very massive order book, indicates that while investors are feeling somewhat fatigued in the sector, they're still willing to add more at the right price, particularly for one of the highest quality credits in the investment grade space. And I also think it's a testament of just how broad the global investor base is for higher rated AA issuers. These companies are basically solid cash generators, which kind of compares to is in contrast to the telecom space in the mid 2010s, where we saw massive releveraging and the cash flows just simply weren't there to meet the liabilities. So to us, it comes all down to the technicals, which I'll get into in the next slide for the market. We don't expect to see AI capex slow down anytime soon. But again, we think fundamentals, for the sector are fairly resilient. We also published a piece. Our U.S. team published a piece this week, really highlighting and going through some analysis on how much global investors can continue to take down hyperscaler debt. For those on the call, I would highly recommend giving that piece a look if you haven't. It's a nice collaborative piece between the U.S. strategy team as well as our technology analyst in the U.S. So certainly would point that to investors for further analysis. The technical side, I think, I mentioned persistent technical headwinds for the tech space, but again, it has not had a broadening out effect on spreads up to this point. We actually think that there's been quite robust positive technicals for the overall market. First half inflows into the US IG asset class totaled around 300 billion. Massive amount of money continuing to come into credit, despite some of these supply headwinds, and despite obviously the move in long end rates over the last month or so. But the reality is that there's a lot of cash still in the system. If you look at the slide on the left hand side, just showing just the amount of assets sitting in money market funds in the U.S. We think that's continuing to put money in investors' pockets, and obviously helping very much the bid for corporate credit, and keeping spreads in check. And the reality is also that equities remain at all-time highs. So I think in general the technical picture is a bit more balanced than the narrative suggests, as we continue to see higher U.S. Treasury yields doing a lot of the work for sort of a relief valve for credit markets. So where does that kind of stand in terms of how we're thinking about positioning in USIG? We expect to see fairly weak excess returns going forward. We think that the asset class still looks pretty compelling from a total return perspective, but really you're being compensated so little for credit spread that doesn't make a whole lot of sense to be pounding the table on overweighting spreads at this point. So in terms of kind of positioning, we like to remain. We think that the most attractive place in the USIG market is probably around the kind of 7-year duration bucket. Seems to be the most compelling from sort of a carry and roll down perspective, and particularly for total return investors, which continue to see inflows across the board despite kind of higher yields. So as that sort of translates to our sort of global views, we are continuing to remain underweight on US credit more broadly. We have an underweight recommended allocation to USIG, and as well as US yield, from the standpoint of kind of thin excess return break-evens, offset by relatively attractive total return opportunities in both asset classes. That being said, I'll jump into now our core views for European credit. We actually think that Euro credit looks pretty attractive in sort of a scenario where we continue to see heavy supply in the tech space. We think that European credit is a relatively defensive asset class, and while there are a number of macro challenges that's sort of unique to Europe, we think that corporate credit is generally a higher quality asset class viewed globally by investors, and we'll kind of get into some of the themes around how we're thinking about our views on Euro credit. So first off, I just want to kind of run through some of the macro themes. Obviously, U.S. Treasury market has not been alone in terms of higher rates over the course of the last 6 months or so. It's really been a broad-based repricing of sovereign yields globally. European sovereigns have not been spared from sort of the sell-off, and we continue to see kind of higher yields and flatter curves as really the dominant theme in sovereign markets. That being said, sovereign spreads still remain generally intact. We have not seen a major spillover in terms of fiscal risk premium in European sovereigns, and we've seen, if you compare, French OATs or Italian BTPs relative to Bunds, the spread remains relatively contained despite, some potential fiscal risks around energy, and then obviously, a sort of a choppy political environment, particularly as we get into 2027. We have the French elections as well as the Spanish elections, but so far, we've seen higher yields in general being looked at as a buying opportunity in European fixed income. And more remarkably, I think, is really the resiliency of European credit, which has been basically unfazed by macro vol. We saw some choppiness in spreads on the very early onset of the Iran conflict, but that's since really kind of compressed, and we've seen spreads kind of trading back to the year-to-date tights, despite some of the challenges. Now, what I think about for as we get, in terms of positioning, how this is going to impact our sort of overall portfolio recommendations, I think one of the key themes here is that European growth, remains, I think, surprisingly resilient. However, basic trends beneath the surface are definitely indicating some fragmentation, continuing to see, exports be a drag on overall growth, offset by relatively strong household spending, as well as the government spending impulse that we've talked about in a number of our kind of European highlight reports in recent years. So I think, overall, the kind of the economic environment for Europe remains challenged, but governments are continuing to find a way, and corporates are continuing to find a way to continue to face, offset some of these challenges as it relates to higher energy cost, rising inflation pressures, as well as higher borrowing costs more generally. Now, our kind of view on European rates is actually a bit counterintuitive to what the market is pricing in today. The market is effectively, looking for the ECB to continue tightening policy through the end of this year. We're of the view that actually, lower rates are needed to stimulate private growth. And we've seen economic growth expectations by large companies remain fairly subdued. At the same time, manufacturing PMIs have basically muddled it around, flatline over the last kind of year or so. So really our call here is that we think that actually lower rates are warranted in this sort of environment, whereas the market seems to be hyper focused on potential inflation pressures as it relates to energy costs, which I'll talk about on the next slide. But in short, we're expecting, we continue to think that investors should fade the hawkish moves in ECB pricing. We think there's an opportunity to be adding to duration in the European markets via kind of intermediate dated corporates. And we'll get into some of those views as well later on these slides. Now, I mentioned energy prices. I do think that is kind of the key overhang for rates more broadly. Right, if you recall back in 2022, energy, inflation was soared almost 40%. I would note, that was a more sustained supply shock to the European energy markets. And in fact, inflation had already been previously picking up leading into the supply shock in Europe. And so we're not seeing those same trends today. While there's definitely been a bit of a pickup on the energy side, in terms of price inflation, has not spilled over to kind of core prices. And so again, kind of going back to my point around policy rates and kind of long-term yields in Europe, we think that there's actually a compelling case to be made that we're sort of near the top of the range in terms of rates going forward. Now let's shift a little bit into kind of how we're thinking about technicals, which I think has been the key linchpin for credit this year. We've seen pretty solid demand for European corporates, albeit slowing from the record pace at the end of 2025. So far, we've seen a bit of a deceleration in fund flows. So we think that actually net demand for corporates has peaked in late 2025 and is probably going to become less of a tailwind for spreads going forward. But nonetheless, we're not expecting to see a major reversal in flows, through the end of this year and in the early part of 2027. So that continues to remain, a kind of a decent positive tailwind for spreads and our more constructive view on European credit going forward. I do think it's worth noting that, much of the strong demand we have seen has been actually from non-European investors, whereas we've seen outward net flows by EU investors. I think part of that is based on the fact that, again, I mentioned Europe as being viewed as somewhat of a, haven asset class. And I think, foreign investors continue to put money to work in a much kind of shorter duration, higher quality market in Europe versus, obviously lower yields in general, lower nominal yields for European investors has them looking elsewhere for better investments. But I think one of the big tailwinds in terms of the technicals also remains that cash on the sidelines, similar to U.S. markets, remains robust. We have over 900 billion of money sitting in European denominated money market funds. As investors continue to accumulate cash, we think that provides a fairly strong tailwind for kind of European credit going forward. Now, in terms of issuance, that also remains kind of a key overhang, definitely not to the same extent as it does in the US. But this year, we're expecting to see basically near record supply on the Euro IG side. We're sort of running around 419 billion or so year to date. We expect to see a bit of a moderation, but really full year issuance kind of getting near all time highs in 2026, as we've seen M&A and Capex really continue to show signs of life. Now, on kind of the fundamental side, I do think there is some concern around rising leverage on the European investment grade side. But so far, as long as companies are continuing to make money, actually higher leverage means magnified bottom line returns. So we continue to think that perhaps this is some area of weakness going forward if the growth narrative does roll over. But for now, fundamentals in our view remain in very good shape. And are supportive of valuations in European credit. And if you look at just the chart on these slides, I mean, earnings growth has been exceptionally robust, particularly in the second quarter of this year, massively outperforming expectations in Europe. Now it's been dominated by a few select sectors, namely sort of the commodities complex, but really broadly speaking, we've seen positive earnings growth expectations for 2026, and that's expected to continue in 2027. So we do think this provides some room for concern if obviously earnings growth expectations are not meeting growth forecasts, but nonetheless, I think it points to really resilient credit fundamentals for despite the fact that we were seeing fairly sluggish economic growth across Europe, more broadly speaking. So I want to just kind of dive into some of our key themes real quick before we turn to EM strategy. On the slide here, we have sort of our three forecasts for the first half of 2027. In our sort of base case, we would expect to see continued economic dispersion. We think that translates to slightly lower ECB policy rates, but really a bigger decline in long-term yields going forward. And then again, that's in our sort of base case scenario. We would expect to see credit spreads widen modestly through the first half of next year. Again, I think 110 basis points on the index level for Euro IG is actually still below sort of the long-term mean, but certainly would represent kind of a shift away from this kind of compressed environment that we're in. Now, on the bull case side, we would expect to see really continued market exuberance, similar to what we've seen over the last 5 months, where spreads basically kind of get back towards the cycle tights. Inflation comes down, allowing sort of rates to fall modestly at the back end. But really, the key theme here is that growth continues to hold up. We have put about a 25% probability of that. And then in our sort of bear case scenario going forward, which we signed about a 20% probability, we have spreads backing out towards about 130 basis points. In that scenario, we expect to see technicals really reverse. Fund flows into European credit move higher as we start to see larger excess return losses as well as total return losses alongside a higher term structure of rates. So that's kind of the way we're thinking about in terms of valuations going forward. Now, I would say that it's been evident that European credit risk has definitely shifted from corporates to sovereigns. I mentioned sovereigns being relatively contained, but if you look at sort of valuations on a long-term perspective, it's very uncommon to see Euro IG spreads trading above basically where French 10-year notes are relative to Bund. So I think that's certainly an important dynamic to consider as we get into 2027 in terms of the relative value opportunity set in European credit, especially now that some of the kind of core European countries are actually now trading wide to European credit. It could be one of those scenarios where we start to see a bit of a crowding out of corporates and into sovereign credit as we get into next year. So how are we thinking about positioning in European credit? Obviously with ultra tight IG spreads, I mentioned we're hovering near the cycle tights. We think that makes sense to shorten spread duration. For investors who are looking for opportunities, we think that the best way to play the Euro market is via curve strategy, playing for really carry and roll down. We think that the best, most compelling place to be along the European IG spread curve is within the 3 to 7 year bucket. We put out a pretty thorough piece looking at this last week. Also should be attached to the the website, this webinar invite. So please take a look at that for further details. We put out a number of trade ideas and name specific themes that sort of meet our duration targets for Euro IG. Now, in terms of how we're thinking about hybrids in particular, that seems to be a pretty topical asset class for most global investors. I think it's very clear that valuations have really compressed to what we've levels we really haven't seen in many years. If you look at sort of the yield differential between IG hybrids and sort of senior bonds of hybrid issuers, we're basically hovering around 50 basis points or so at the index level. That being said, I think overall valuations kind of mask some dispersion at the sector level. You can see on the right hand side here, this is hybrid versus senior yield differentials of hybrid issuers. You can see quite a wide range of valuations spanning from kind of the wide end at capital goods and real estate down to sort of the tight end of utilities and technology. So overall, we think that at current valuations, we still continue to like hybrids as an asset class, but we would prefer to move down the capital structure in higher quality, more defensive sectors such as telecom and utilities for if you're looking to continue to add to the space. And lastly, before we roll into our EM outlook with Regis, I just want to go over some of our sector recommendations where we have a quite favorable view, I would say, on telecom and utilities. We think these are really kind of high quality, longer duration sectors. We think most of these names are positioned with very strong balance sheets and pretty strong ability to generate positive free cash flow. So we continue to like those two sectors from an outperform perspective. And then where we're a bit more concerned is around some of the more cyclical names within European credit. Recently, we downgraded our view on European autos from an overweight all the way down to an underperform. We did that in our second half outlook. We think that some of the fundamental challenges are going to remain for the space, and it's really just one of those sectors that continues to be highly indebted. And it's going to take quite some time for really the trends to reverse before issuers start to look more heading in the right direction from a sort of a balance sheet management perspective. We're also underweight basic industries. That's namely around exposure to chemicals, where we have a pretty cautious view in terms of the outlook for chem names. And then we have an underweight in retail, where we think really just there's not a lot of value in the space. We think there's potential for some M&A risk, and we've seen kind of a continued slowdown in demand, especially on the luxury side. So we're underweight that space. All right, that about wraps up my comments for U.S. and European credit. Now I want to hand it over to my colleague, Regis Chatellier, who is the head of EM Sovereign Strategy for CreditSights. Take it away, Regis.
Yeah, thanks, Logan. Emerging markets. It's been a difficult first half of the year. First of all, I would mention that emerging markets experienced a pretty meaningful economic slowdown as a result of the war in Iran and the closure of the Strait of Hormuz. EM GDP overall grew by 3.2% year on year in the first quarter. That's a clear slowdown from nearly 4% in the previous quarter. The deceleration was particularly marked in GCC countries for obvious reasons, right? Due to the dependence of the Strait of Hormuz for exports, but also more broadly, countries like Turkey was also very much affected by because of the high reliance on oil imports. The shock was also quite significant in other countries like Romania, Chile, Mexico, Philippines, for example, where the weaker momentum was also compounded by political domestic factors. The impact in inflation, aside from growth, the impact of inflation was even more pronounced, especially in Asia, with countries like Philippines, for example, inflation reaching 7%, Pakistan close to 12%. The impact was strong in Egypt, South Africa. In Latin America and Eastern Europe, the rise in inflation has been more moderate, but it should be noted that inflation in both regions was already relatively high before the conflict. Now, what's next going forward? I think the conflict is with Iran is far from being resolved, as reflected sadly by the frequent attacks on cargo vessels and U.S. strikes on Iranian installations. But I would say the willingness to reach an agreement between the U.S. and Iran is probably now more tangible. In fact, U.S. is approaching midterms. It's an uncomfortable situation for the current administration, and for Iran, it's probably not a sustainable situation. So, the recent renegotiations between Iran and Oman could be a first step towards an agreement. That's what we would think. In this context, we would imagine or would believe that economic activities it will recover next year. EM GDP is projected to rebound to 4.8% next year. That's would be that scenario would mean a widening gap between the US and the Eurozone. US is probably going to grow around 2.2% next year and Eurozone 1.2%. So for EM, 4.8 is clearly way above developed markets. So this is pretty good prospect. Asia is expected to continue to lead growth in EM with Philippines and Indonesia and India leading the pack. However, we can see, we would expect significant rebound in the Middle East with growth in Saudi Arabia and UAE exceeding 5% next year. Egypt, Morocco, Nigeria also expected to grow at sustained pace. So some countries clearly will see a rebound, going forward. Now, in terms of weaknesses in EM, we still have external trades overall could weaken further as U.S. sectoral tariffs remain in place. At the same time, the war in Iran, the war against Iran, has driven a sharp rise in energy prices and disrupted the region's oil and gas export capacity. On the fiscal side, and that's what you can see on your screen or on the presentation, fiscal discipline has generally been better in emerging markets than developed economies. However, high energy costs have affected public finances across EM, and I would expect EM fiscal deficit overall to average 4.2% of GDP, which it's clearly significant, and that's reflecting elevated debt serving costs. That's basically owing to the previous commodity shock that has pushed funding costs higher. Now, among the countries that will likely continue to register big fiscal deficit, I would mention China, India, Egypt, Brazil, and Eastern Europe overall are expected to register pretty sizable budget deficit. But on balance, I would say EM fundamentals remain quite decent, especially in terms of growth prospects. But we see some weaknesses, especially in terms of fiscal deficit. In this context, I would expect less rating upgrades this year or in the coming 12 to 18 months than the past 3 years. The past 3 years have been a pretty strong. I've seen a strong sequence of rating upgrades. Now, if you look at outlooks from rating agencies, you have pretty much even negative outlook versus positive outlook. And that's probably reflecting the fact that a lot of upgrades have already happened, and the situation, of persistent instability can weigh on future upgrades. Now, in terms of what is priced in the bond market more specifically, well, as Logan mentioned, spreads are very tight. We still have EM bonds offering attractive carry with an average yield to maturity of 6.3%. That's clearly above the long-term average of 5.8%. And combined with ample liquidity in the market, that probably explains the persistent inflow into EM. However, risk premia appear exceptionally tight, with spreads now clearly decoupled from global liquidity conditions, or financial conditions, and based on historical relationship, investors are effectively pricing EM sovereign credit market as a triple B plus as a class, which is about 2 notches above its current rating. If you look more specifically in sovereign IG, we have an underweight call. The asset class trades at an average spread of 85 basis points. That's the tightest level since 2007. At these levels, future performance will heavily depend on U.S. Treasuries, with little scope for excess returns. As far as sovereign high yields are concerned, also very tight. Average spread of 260 basis points also over Treasuries. That's the tightest levels in 20 years. Now, it doesn't mean that there's no opportunities out there in the market. We have some countries, especially in LATAM, for example, that can offer interesting potential. I would mention, so the graph that in this chart, the trend is not there, but basically you have the green dots are showing the overweight calls, and the red ones are the underperform or underweight. At this point, I like Colombia, Chile, and Peru. These 3 countries have seen a significant shift towards, or political shift, and it likely focus on fiscal consolidation going forward. That's a big change for Colombia. Colombia comes a long way with fiscal deficit has been widening, and the external balance has been also under pressure. With the new administration, we would expect a clear shift towards fiscal consolidation, and I think valuations are still pretty attractive at the current levels. When we have Peru and Chile, we have similar situation in a way. Obviously, we're talking about credits that are trading much tighter, much better credit quality. But I think the upside is still there. Chile, there's still some uncertainty around like copper productions, but at the same time, copper prices have been clearly on the rise, and that is offsetting the risk on external balance. Peru, I guess the new administration of Keiko Fujimori is going to put a lot of focus on making sure that the fiscal discipline is there, and implement, I would say, market-friendly policies. Aside from LATAM, I like Morocco and South Africa. Morocco has been it's a kind of a small country, obviously small credit, but interesting dynamics with strong growth. Fiscal discipline or fiscal has been improving slowly but surely. But Morocco has clearly shown a commitment to develop its economy. And I would imagine that going forward, the country is going to regain full IG status. We have already one rating agencies rating as a triple B minus for Morocco. I guess the other 2 rating agencies are going to follow suit. South Africa has been a bit of surprise. The new coalition has been a strong commitment for fiscal discipline, and it has surprised the market. In a way, growth is not as strong as it should be, but I guess we're coming from many years of fiscal, a very loose fiscal policy, and aside from that, we still have, despite the fact that oil prices have been going up, the terms of trade have been still positive for South Africa, and I would imagine some future upgrades are sort of likely for South Africa. So I'm still await. I still maintain a very cautious call on some countries. Philippines, for example, difficult environment where inflation is clearly under pressure, and it's going to be very difficult to maintain fiscal discipline in this environment, considering that growth has been under pressure as well. So valuations are very, very tight. Romania, still a lot of uncertainty, a lot of positions, or, the coalition's under pressure, massive twin deficits. It's going to be difficult to get to the next step, even though there is a support from EU. But um, I guess risks are still there. Lastly, Egypt. It's not that I don't see progress. In fact, Egypt has been growing fast, and there has been some progress on the inflation side. Now, the budget is still massively under pressure, with a fiscal deficit exceeding 10%. A lot of investment from the UAE, of course, but the Middle East overall, that support growth. So I would say, in on balance, I would say the economic situation is not that bad, and there's still strong commitment from the IMF and GCC countries to invest in the country, but valuations are a bit tight, and that's true overall for EM high yields. I would be a bit more cautious as far as Egypt is concerned. I'm going to stop here for EM. I'm happy to answer some specific questions, if any.
Thank you very much. So I'm going to take over the baton from Regis. My name is Pramod Shenoi, and I head APAC as well as GCC for the financial sector, as well as the overall head of research. So I'm just going to go through 3 slides at the moment, providing a quick overview of first what we see in the GCC, secondly, our recommended trades, and thirdly, an overview of key recommendations. So first of all, for the GCC, it's good timing in terms of this webinar. We're just done with the results season from the banks in the region. And by and large, we're very positively surprised with a good set of results. So whereas the conflict in the region has certainly slowed some of the really strong growth that we'd seen in January and February, the banks have still come out looking pretty good. In particular, in Saudi, despite the recent GDP numbers, the banking sector looks to be in very good shape. And all the positive changes from Vision 2030 are certainly making themselves felt across the banking sector. We cover the top 5 banks there. In the UAE, we covered the top 4 banks. What we were quite impressed by in the UAE was, for the banks that we cover, the fee income in the second quarter was higher than that of the first quarter. Now, we knew that January and February was very strong, and March was challenged. But as a whole, Q1 was not bad. But for Q2 fee income to be even better means that there is good underlying momentum. So we do appreciate that a number of corporates in the region are a little cautious about what their growth plans are, but that's not making itself manifest in the banking sector at the moment. Qatar, we cover QNB, and they've actually very, very modestly changed their outlook for the year. So again, that looks good overall. We're now going to move into our recommendations across the GCC and financials and APAC financial space. And if you'd ask me, what is it that investors should consider across this particular space, I would say for short duration, call it the 2-year bucket, 2 to 3 year bucket, I would look at India high yield, selected NBFI names such as Muthoot and Manappuram, very good gold financiers, as well as Mong Thai Capital from Thailand. At the intermediate part of the curve, which is, call it 4 or 5 years, I like Saudi Bank Tier 2, in particular Bank Saudi Fransi and Riyadh Bank. I think if in case you're getting about 200 or 200 over for the credit quality, that's a very good return. And for duration, I don't like to mix credit risk and duration risk, so I prefer to keep safe. Here, I really like the tier 2s of the Japanese insurers. You're getting about 150 over for each of these names, non-call 9s at the moment, as well as an 81 from SMFG. So overall, these are the key recommendations that we have for investors in this particular space. Lastly, I just wanted to give a quick overview of our recommendations because we classify them as outperform, market perform and underperform. If you don't see a particular name on this sheet, that means that we have a market perform on them, but we are outperformed the Japanese insurers, tier 2 sector, the Indian NBFIs, selected IG NBFIs. We like the Japanese mega banks, Hong Kong banks, Indian bank seniors. We talked about the tier 2s from Riyadh and BSFR, also recent First Abu Dhabis. We are more cautious on Thai, Philippines, Indonesia, and a few other jurisdictions as for the macro conditions that Regis has partially pointed out for the Philippines, for example. I'd also like to highlight that for those of you watching this webinar, on the bottom left-hand side of the page, you will see a few PDFs. We have our the latest APAC financials, RV and Outlook over there. We also have a monthly that we publish at the beginning of every month with the best trade ideas in the APAC region. So we would encourage you to take a look at that. And of course, in case you do have any questions, please do reach out to us. With that, I'll hand over to Lakshmanan, who will walk you through the corporate segment of GCC and South Asia.
Right. Thanks, Pramod. Hello, everyone. My name is Lakshman. I'm responsible for South and Southeast Asia and Middle East corporates research, where I cover corporates across a wide range of credit rating spectrum, all the way from IG to stressed, and across multiple South and Southeast Asian countries, and of course, the Middle East. So in this brief segment, I'll put across my views on the Middle East and also some select Indian corporates, because we do know that there is quite a sizable investors who look at the Indian credit space out from the Middle East countries and cities. Okay, so in this section, I'll just first tackle the elephant in the room, which is the Middle East situation and our views on select GCC corporates. So in the Middle East war theater, the control over the Strait of Hormuz has now taken center stage. The commercial maritime traffic has ground to a halt, and Qatar Energy, or QE, remains the most exposed credit due to a complete reliance on the SOH for LNG exports and the associated sovereign rating downgrade risk. The Qatar Energy's Ras Laffan plant suffered very extensive damage that took out about 17% of its capacity, and which will take nearly 3 to 5 years to repair at a steep cost of $26 billion. If this conflict continues, the UAE property developers, especially the development property-focused high-yield companies, will be negatively affected, as they have little recurring income to fall back on. The foreign investors will pull back from investment property purchases, and the construction supplies will also tighten as supply chains become more constrained. Dubai Ports, or DP World, is also in a pretty tricky position, as its flagship Jebel Ali port is quite entirely dependent on the traffic flowing through the Strait of Hormuz. We expect the impact on the EBITDA to be cushioned by recurring long-term leasing income from Jebel Ali Freeport Zone that contributes nearly 60% to the Jebel Ali port ecosystem. DP World also has geographically diversified assets outside of the UAE. We are also comforted by the company's very robust liquidity position that fully covers its short-term debt, multiple funding access, prudent Capex, and dividend rationalization. Yet, when we look at the FY26 credit metrics, we believe that it could worsen by a turn if the Strait of Hormuz remains blocked for over a year, and which could exert rating downgrade pressure at Fitch Ratings. Saudi Aramco is a very widely traded liquid name. We like its fundamental credit outlook, as its facilities have remained relatively unharmed in the ongoing conflict, at least so far. Unlike its regional peers, its access to the Red Sea provided an alternative route to ship oil and gas exports to the destination markets. Its east-west pipeline has been instrumental in diverting oil and gas, initially flowing through the Strait of Hormuz to the Red Sea coast instead. While it still registers a double-digit decline in oil shipments versus pre-conflict levels, it is more than offset by the sharp rise in crude oil prices. The recent significant escalation wherein the Houthis have threatened to block the Bab el-Mandeb Strait that provides access to the Red Sea, and the potential for future attacks on the East-West pipeline pose growing risk to Aramco's outlook. Saudi Electricity is as a very avid dollar sukuk issuer in the GCC region. All its 13 outstanding dollar bonds are in the sukuk format only, which likely sees very strong regional demand, not just from GCC investors, but also from Malaysia and Indonesia. It is a very defensive utility name, and none of its power plants have been attacked during this recent conflict. Saudi Electricity holds strategic importance for Saudi Arabia and enjoys regulated power tariffs with cost pass-through mechanism too. When we look at the midstream pipelines in this region, we like the credit profiles of Galaxy Pipeline and Green Safe Pipelines, as these two do not bear any operational risk, which are transferred to their respective counterparties or off-takers, that is Abu Dhabi National Oil Company and Saudi Aramco respectively. These contracts are laid out in their long-term agreements that stretch to as long as 2042. The pipeline companies are paid an annual lease income for at least a minimum volume commitment and at fixed tariffs, which remain in place even in the event of a force majeure event, including disruption or extensive damage to the pipelines from armed strikes. Also, the repair cost and insurance fees will be borne by the counterparties and not the pipeline companies. And these counterparties have a very sound credit profile, being strategic oil and gas quasi-sovereigns. Like I mentioned at the start, we do recognize that quite a few Middle East financial institutions caters to a sizable Indian diaspora who hold or are keen to invest in good quality, familiar household names. So we will only touch upon a couple of Indian names in this segment. So the major Indian renewable companies, the likes of Greenco, Renew, Adani Green and Continuum, could see a surge in demand for renewable power as coal and natural gas costs surge amid the Middle East conflict. Yet, they operate on a must-run status already, and power production from natural sources cannot be ramped up at will. While the operating earnings will not benefit materially, the sector will likely see a spurt in capacity growth, probably at the expense of coal and natural gas capacity growth. However, this could still be subject to transmission grid constraint that the Indian renewable companies are increasingly facing. With this in mind, the Capex, debt requirements and leverage is likely to remain elevated even going forward. Vedanta is a name that continues to have a lot of investor interest. It is a name that it's a credit that is steadily on the path of solid credit improvement. This has been attributed to sustained high metal prices, particularly of aluminum and crude oil, robust near-term volume growth, which you can see in this chart, and all this comes despite rising mining costs due to energy prices. Despite the combination of these, we still expect the EBITDA to inch higher. With it, Vedanta will look for opportunities to buy back the residual dollar bond tranches at par with fresh funding to further reduce their interest burden. The recent completion of demerger paves way for the holding companies to trim stakes in the operating subsidiaries for deleveraging, further assisted by brand fees and dividend upstreaming. The rating agencies have rightly rewarded Vedanta's credit profile improvement with multiple rating upgrades, taking it to a BB category now. In the Vedanta complex, we like the newly issued bonds for spread compression and coupon carry, as well as the existing residual bonds because they have a very high coupon and therefore provide a very high carry return. Going to the final section wherein we will look at our investment recommendation, I will start off with a list of issuers and securities on which we have market perform recommendation. This is restricted to the GCC and the Indian corporates only. Not on our recommendation on the rest of the South and Southeast Asia space. So of particular interest, we believe to the GCC-based investors are one or two credits, in particular being JSW Steel and Delhi Airport. So JSW Steel is a prime rising star candidate. We have already seen that Moody's has already upgraded it to IG rating very recently. The company has delevered by selling a 50% stake in Bhushan Power and Steel to Japanese JFE Steel and by forging a JV with POSCO to mitigate the impact of its large Capex plans. The other name that I would like to highlight is Delhi Airport, which is in a near Goldilocks situation, following a very steep tariff hike which has come into place, anticipated gradual credit improvement from steady passenger volume growth and very low Capex right up to 2028. Okay, so here is our top picks from the GCC and India. We like select bonds of the two pipeline companies that we mentioned, GreenSafe and Galaxy, for their robust business profile that offers very solid revenue visibility even in the event of a force majeure event. Saudi Aramco is another name that we like, particularly the 54 to 64 part of the curve that offers value. The issuer in itself benefits from tailwinds from very strong oil prices, and it still has access to the alternative route that passes through the Red Sea, provided that is not cut off in the recent scenario of the Houthis launching or escalating the conflict. Like we mentioned, we like Vedanta's bonds for both spread compression and attractive carry for an improving BB- like credit. Finally, Renews 2031 is one of the few Indian renewable bonds that we like at this moment. So under our pants, and this is the final slide in the segment, we have underperformed recommendations on Adani Green and Adani Ports for their very aggressive Capex, murky governance track record, and tight bond valuations. We dislike Dubai Port World's 2049 only due to tight bond valuations, even as we like some of the other bonds within the complex and that we touched upon earlier. So that brings me to the end of my presentation. Thank you. And I will now pass on the time to Logan. Back to Logan.
All right. Thank you very much, Laksh, Pramod, and Regis. We've gone around the world in about just over an hour. Unfortunately, we're running against the clock. So if we weren't able to answer your direct questions in a prepared remarks, we'll make sure to follow up after this call. I want to sincerely thank everyone for listening in. Your partnership is very much appreciated. We hope you found this webinar helpful to your investment process. If you have any feedback, we welcome a direct dialogue with us using the Ask an Analyst tool on the CreditSights website, or you can reach out to your friendly CreditSights sales or customer success representatives. I hope everyone enjoys the rest of summer and gets some time to unwind before a busy closeout to the year. Best of luck throughout the final stretch, and please let us know how CreditSights can be of any assistance. Thanks again, everyone.